So I invested £10 every single day into the S&P 500 for 180 days now. And these results might indeed shock you. So I decided to invest into one of Trading 212's cheapest S&P 500 funds. This is the SPDR S&P 500 UCITS ETF that allows UK investors to get a slice of the S&P 500 action without having to pay a ton of fees. Now this video is very interesting because right as I film on day 180, the stock market is taking a bit of a tumble. My previous update 30 days ago was quite positive, and then no one watched that video because by the time that came out, the stock market went down around 3%. So this is the health of the S&P 500 as we talk. The S&P 500 is not doing well, down by over 1% today. Over the past 5 days, the S&P 500 is heading towards a negative 3%. So since my last update, as you can see, this has been around 30 days, 1 month. The S&P 500 is down by over 1%. Now, obviously, over 6 months, the S&P 500 has been doing extremely good, up by over 18%. Year to date, up by nearly 13%. And then over the past year, up by over 11%. So in this series, we are constantly asking the same question: would it be better if we had lump sum invested or dollar cost average basically every single day? You're going to find out because I'm going to go through all of that in this video. So as always, I'm using the Trading 212 app, my favorite platform. And if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, then all you have to do is to follow the link in the description box down below. Alternatively, if you've already signed up to Trading 212 over the past 10 days and haven't received your free fractional share, all you have to do is to press the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this section, just enter my code JUBAIR and you should receive a free fractional share. So like I said, I've been investing £10 every single day. Here are the receipts, but I'm going to scroll all the way down to show you where the journey begins. So as you can see, the journey begins on the 12th of May 2025, and I intend to do a full year of investing £10 every single day. It's going to make for a hell of a series in my opinion. So on the 12th of May, I purchased my first £10 worth of shares into the SPXL. So back then, one share cost £10 and 74.4 pence. So £10 worth got me around 0.93 shares. So like I said, I've been investing £10 every single day for 180 days now. So if I could roll back time and start with £1,800 and I put that all in on the 12th of May, right now I would have 167.54 shares in the SPXL. We're going to use that number to compare whether or not, once again, lump sum is better than dollar cost averaging in this very specific experiment. Now, it goes without saying that if we started at a completely different time with more market volatility, then the results would be different. So I started on the 12th of May. From the graph here, you can see that it was just a few weeks or a couple of months after the stock market dip of 2025, where we saw the S&P 500 going down by about 20% as a result of the tariffs placed across the world by the United States of America. Now, that dip was a very flash crash, and a lot of people were wondering whether or not it would happen again. And as you can see, on the 19th of May, the stock market did dip a slight amount, and obviously at that point in time, everyone was thinking, should I invest now or should I wait? But this series was created to show you that regular investing can really have its benefits regardless of what market conditions there are out there. So essentially, I created a pie where I would invest £10 every single day automatically because I have auto invest on here. However, one thing that it does do is over the weekends, it takes £10 out of my available cash into the pie, but obviously the stock market is closed over the weekends. So basically on Mondays, £30 is put into the stock market. There could be a way around it. I could have invested manually every single weekday, but I wanted to keep it on a per day basis. I'm just letting you know this because every experiment will be different. Now, like I said, this day has not been great. We are down by 1.6% today, over £31 of unrealized loss. Again, over the past week, down by around 3% or £59.86. Now, over the month, the story changes. We are still up by 0.9% or £16.25. Now, as you can see from my net deposits, I've deposited a total of £1,800. So that's £10 a day for 180 days. So let's check check out the final results over 180 days. You can see overall I am up by 7.21%. Now that return over about half a year, because there's 365 days in a year, is almost exactly a half. Personally, I would say that is pretty great. We would expect the banks to give around 3 to 4% over a whole year, so this definitely is a lot higher for 6 months. Now obviously when you're investing into the stock market, you are taking on risk that the banks don't necessarily have. So is it really worth it? So over that time period, I am up by a total of £129.84. This is all unrealized gain. I haven't realized it. Now it is worth noting that we are not currently at super all-time highs, and there was a point where I was up overall by over £200. Unfortunately, that is not the case today, as is the stock market, very unpredictable. So when we go into the SPXL, you can see currently my shares are worth £1,929.84. Now, more importantly, I have 155.66 shares in the SPXL. Now, if we had lump invested instead with £1,800 on the 12th of May, I would have had 167.54 shares. Now, clearly, we would have been better off with the lump sum in hindsight, but how much better off would we have been? So given that the current price as markets closed in the UK was £12.39 or £12.40, if I had lump sum invested on the 12th of May instead of dollar cost averaging £10 every single day, I would have had a balance currently of £2,077.10. That is quite a big difference, because if I had lump sum invested, I would be better off today by £147.26, or in other terms, that's around 14 days worth of deposits better off, rather than dollar cost averaging £10 every single day into the S&P 500. If I absolutely had to choose between the two, I would always lump sum invest. This is because we as investors, expect the stock market to go up. Then why not invest everything at a single point in time? It could either go down or up, but when you next invest and it has dropped, you can benefit from those lower prices. Obviously, dollar cost averaging could be a decent strategy, and if the markets were way more volatile, then dollar cost averaging could have its benefits. Personally, I'm very interested to see in the next 30 days what happens to the S&P 500 and what happens to this experiment. So make sure to check out some of my other videos, and I'll see you in the next video.